We need to have a serious talk about the guy in the suit who keeps telling you everything is going to be fine. If you turn on CNBC right now, you are being fed a masterclass in financial gaslighting. You'll see a bunch of over-caffeinated anchors in expensive makeup aggressively high-fiving each other because the Federal Reserve just executed a hawkish pause. They will point to a bunch of shiny green arrows on the screen and tell you that new Fed Chair Kevin Warsh is a monetary genius, that the system is stabilizing, and that the adults are finally back in the room. But if you zoom out, and I mean really zoom out, past the daily noise of Wall Street algorithms front-running each other and retail deacons gambling their rent money on zero-day options, the math reveals a horrifying reality. The Federal Reserve is not trying to save you from inflation. They are not the benevolent wizards of the economy, bravely battling rising prices to protect the middle class. Inflation isn't an accident. It is a highly orchestrated mathematical necessity. It is a stealth tax, deliberately engineered to quietly strip mine your purchasing power so the U.S. government can survive its own apocalyptic balance sheet. The Federal Reserve actually needs your cost of living to skyrocket. They want you to stay poor, and I'm going to prove it to you using their own data. To understand what's actually happening to your wallet, we have to explain how sovereign debt works. And to do that, we need to use an analogy. Imagine your roommate is a degenerate gambler. Let's call him Uncle Sam. Uncle Sam doesn't really produce anything of value anymore. He just sits on the couch, ordering Uber Eats, funding foreign proxy wars, and buying shiny new aircraft carriers on a credit card that has your name on it. Over the years, Uncle Sam has racked up a terrifying amount of debt. We're talking over $35 trillion. That is a number so large the human brain physically cannot comprehend it without short-circuiting. Now eventually, the credit card company calls. The interest payments on Uncle Sam's debt have become so massive that he can barely afford to pay the minimum balance, let alone the principal. In the real world, a rational person in this situation has two choices. Option 1, to default. You declare bankruptcy, take the massive hit to your credit score and start over. Option 2, austerity. You cut up the credit cards, cancel the Netflix subscription, stop eating out, and aggressively pay down the debt over a decade of miserable penny pinching. But for governments, both of those options are political suicide. If the U.S. government defaults on its debt, the global financial system instantly vaporizes in a catastrophic mushroom cloud of margin calls. Because U.S. treasuries are the pristine collateral holding up the entire world economy. And austerity? Please, imagine a politician going on live television and telling voters, hey guys, sorry, no more stimmy checks, we are cutting Social Security, Medicare is gone, and we are raising your taxes by 40% to pay for the bad decisions we made over the last 30 years. They would be chased out of Washington with actual pitchforks by sundown. Which brings us to door number 3, the secret option, the shadow mechanic that central banks have used for centuries to survive when they are trapped in a debt spiral. You inflate it away. If Uncle Sam owes $100,000 and he magically creates a scenario where the price of everything doubles, the relative value of that $100,000 debt gets cut in half. He still owes the same nominal amount of money, but the money itself is worth significantly less. The debt simply melts away in real terms. But here's the catch. For this magic trick to work, the central bank has to ensure that inflation runs hotter than the interest rate they are paying on the debt. Think about it like a bad Tinder date. The Fed is sitting across the table, maintaining intense eye contact, telling you how much they value price stability and how they are totally committed to a 2% inflation target. But under the table, they are aggressively swiping right on every monetary policy that devalues the currency. They are acting like a cheating partner who stole your debit card, but swears they will pay you back after just one more hand at the blackjack table. And if you look at the raw data right now, the system is functioning exactly as they intended. The data deep dive. Let's look at exactly what happened in June 2026. The media spent weeks hyping up the FOMC meeting. The Federal Reserve, under the new leadership of Kevin Warsh, proudly announced they were holding the federal funds rate steady at 3.50% to 3.75%. Wall Street cheered. The headlines read hawkish pause, and Fed stands firm. But here is where it gets ugly. Just days before that rate decision, on June 10th, the Bureau of Labor Statistics quietly dropped the May 2026 Consumer Price Index report. And what did it show? Headline inflation had just accelerated to 4.2% year over year. Let me repeat that. The Fed is holding interest rates at 3.5%, while inflation is running at 4.2%. For the uninitiated, this creates something called a negative real yield. It means the cost of borrowing money is literally cheaper than the rate at which money is losing its value. If you have a savings account paying you 3.5% right now, and the stuff you actually need to survive is getting 4.2% more expensive every year, you are not making money. You are slowly, mathematically bleeding to death. And if you dig into the actual CPI report, the bleeding is much worse than the headline number suggests. The government loves to talk about Core CPI, which strips out food and energy because, it's not like human beings need to eat food or drive cars to survive, right? It's a completely fabricated metric designed to make the numbers look less terrifying. But if you look at what real people are paying, in May 2026, the energy index spiked by 23.5% year over year. Gasoline prices were up 40.5%. The food index was up 3.1%. And while the cost of simply existing is skyrocketing, what is happening to your paycheck? The exact same BLS report showed that real average weekly earnings for employees actually decreased by 0.15% in May. You are getting poorer in real time, and it is entirely by design. Why? Because the Federal Reserve is trapped. The U.S. government currently owes so much money that if the Fed actually raised interest rates high enough to kill inflation, let's say raising rates to 6% or 7% to crush a 4.2% CPI, the interest expense on the national debt would instantly bankrupt the Treasury. We are already at a point where the interest payments on U.S. debt exceed the entire budget of the Department of Defense. We spend more money paying the interest on our past mistakes than we do on the entire United States military. If Kevin Warsh and the Fed actually did their job and raised rates to historically normal levels to fight inflation, the government would have to issue trillions in new debt just to pay the interest on the old debt. It would trigger a sovereign debt crisis that would make 2008 look like a minor accounting error. So they literally cannot fight inflation. They have to let it run hot. They have to cap interest rates at an artificially low level, 3.5, while letting inflation run higher, 4.2% or more. And here's the thing, this isn't a new strategy. It has a name. Economists call it financial repression, and the government has done this to you before. If we jump into the financial time machine and go back to the 1940s, right after World War II, the United States had a massive debt problem. The debt-to-GDP ratio was over 110%. The government had borrowed heavily to fund the war effort, and there was no mathematical way to pay it back through normal taxation. So what did the Federal Reserve do? They colluded with the Treasury Department to implement something called yield curve control. They legally capped the interest rate on government bonds at around 2.5%, and then they just let inflation absolutely rip. From 1946 to 1948, inflation surged to nearly 20% in some years. If you were a patriot who bought a U.S. war bond yielding 2.5% during that time, you got utterly destroyed. Your purchasing power was annihilated. But for the government, it was a miracle. Because inflation ran so much hotter than the interest they were paying, the real value of their debt plummeted. By the 1950s, the debt-to-GDP ratio had been magically cut in half. They didn't pay off the debt. They defaulted on it in slow motion by destroying the value of the currency that the debt was denominated in. And that is exactly what they are doing to you right now in 2026. They are using financial repression to melt away the $35 trillion debt block. They are capping rates at 3.5%, letting inflation run at 4% to 5%, and praying that the middle class doesn't wake up and realize they are the ones footing the bill. The aha moment, which brings us to the most insidious part of this entire system, how they actually hide this wealth transfer from you. Because if the government just came out and said, we are confiscating 5% of your wealth every year to pay off our bad debts, there would be riots in the streets. So instead, they manipulate the data. Have you ever wondered why the official inflation rate always feels like a complete joke compared to your actual grocery bill? Have you ever looked at a CPI print of 4.2% and thought, are you kidding me? My rent is up 15%, my car insurance doubled, and a pack of chicken breasts requires a mortgage application. That's because the CPI is arguably the most heavily manipulated economic metric in human history. Back in the 1980s and 1990s, the government realized that if inflation ran too high, they would have to pay out massive cost of living adjustments for Social Security, which would blow up the budget even faster. So they literally changed the math. They introduced a concept called Hedonic Quality Adjustment. I swear I am not making this up. The Bureau of Labor Statistics argues that if a product goes up in price, but the quality of that product also improves, it doesn't actually count as inflation. So, if a new car costs 20% more this year than last year, but it comes with a slightly nicer touchscreen and a backup camera, the BLS will adjust the data and tell you that the price of the car didn't actually go up. You are still paying 20% more at the dealership. Your bank account is still bleeding, but on the official government spreadsheet, zero inflation. Then they introduced something called substitution. The original CPI was supposed to track a fixed basket of goods, but the government decided that if beef gets too expensive, consumers will just substitute it with chicken. And if chicken gets too expensive, you'll buy beans. And if beans get too expensive, I guess you'll just forage for moss in your backyard. By constantly changing the items in the basket to whatever is cheapest, they artificially suppress the official inflation rate. Oh, your steak costs double? Just eat bugs and the CPI stays flat, peasant. But the absolute crowning achievement of governmental gaslighting is how they calculate housing costs. Housing is the biggest expense for almost every human being on Earth, but the CPI doesn't actually track real-time home prices. Instead, they use a fictional survey-based metric called owner's equivalent rent. They literally call up homeowners and ask them, hey, if you're going to rent out your own house to yourself, how much do you think you would charge? I am entirely serious. That is how they calculate housing inflation. They use imaginary data from people guessing what their house might rent for, which mathematically smooths out the massive spikes in real housing costs. So when the BLS tells you that inflation in May 2026 was 4.2%, you need to understand that this is the heavily manipulated, massaged, politically acceptable number. True inflation, the actual rate at which your purchasing power is dying, is substantially higher. And this is where the twist happens. This is the moment where you realize how the system is perfectly designed to trap you. Because who benefits from financial repression? And who pays for it? The people who benefit are the people who hold massive amounts of debt and the people who own hard assets. If you are a billionaire or a massive Wall Street private equity firm, inflation is your best friend. You borrow money at fixed rates to buy real estate, infrastructure, and equities. As the currency debases, the nominal value of your assets skyrockets, but your debt remains fixed. The inflation literally pays off your loans for you, but what if you are a regular person? What if you are part of the shrinking middle class? You are taught from birth to play by the rules. You are told to go to school, get a good job, save your money in a bank account, and be financially responsible. But in a system running on financial repression, being responsible is financial suicide. If you hold your wealth in cash, or in a high-yield savings account paying you a cute little 4%, you are the ultimate loser in this game. You are providing the cheap liquidity that the banks use to gamble on derivatives. You are the exit liquidity for the system. The government is systematically transferring wealth away from wage earners and savers and handing it directly to asset owners and debtors. You aren't getting a bill in the mail for this tax. You are paying it every time you go to the grocery store and realize your paycheck buys 10% less food than it did last year. You are paying it when you try to buy a starter home and realize the down payment has mathematically outpaced your ability to save for it. And the psychological manipulation is brilliant. The media and the politicians have trained you to blame everyone except the central bank. When prices go up, they go on television and blame corporate greed. They blame supply chain bottlenecks. They blame greedy landlords. They blame the war in the Middle East. They blame Putin. They blame the weather. They will blame literally anything and anyone to keep you from looking at the money printer. Because if you actually understood that the inflation crushing your family is a deliberate policy choice, a choice made by unelected bureaucrats in a boardroom to save the government from its own catastrophic spending, you would stop fighting with your neighbor over meaningless political theater and you would start asking real questions. And that is the terrifying, unvarnished truth about the Federal Reserve in 2026. They are not confused. They are not making a mistake. The hawkish pause, the careful speeches, the complex jargon about data dependency and transitory supply shocks, it is all theater. The system is not broken. It is functioning exactly as it was designed to. You are a battery. Your wages, your savings, and your stolen purchasing power are the energy source that the government is using to keep the debt bubble inflated for one more cycle. They need you to stay poor, because if your money retained its value, their debts would become unpayable. So the next time you see Kevin Warsh or a CNBC anchor smiling on television, telling you that the Fed is holding the line and inflation is under control, just remember that you are the one paying for that smile. They are going to keep inflating the debt away until the currency breaks or the bond market collapses. There is no soft landing. There is no happy ending tied up in a neat little bow. There is only the math. The only question is, what are you going to do about it? Are you going to keep your wealth in fiat currency and let them melt it away, or are you going to opt out of the system? Let me know in the comments below. Do you think the Fed will eventually lose control of the bond market? Or will they manage to boil the frog slowly enough that the middle class just accepts living in a neo-feudal dystopia. If you want to survive what's coming, you need to understand the rules of the game they are forcing you to play. Hit the subscribe button, turn on notifications, and stop listening to the guys in suits. Because in the casino of central banking, the house always wins, and you are not the house.